This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Thursday, April 9th, 2015. I'm Lee Adler. Well, it's been about 2 weeks since we last got together, and the market drifted higher, has been drifting higher for the last couple days. And my thought is that if you're a bear, boy, it's time to start praying for the next couple weeks, because we're coming into a period of seasonally very bullish liquidity. And the cycles are starting to line up for a bullish move as well. The 13-week and 6-month cycle lows are due around mid-April. It looks like they may have bottomed early with that double bottom on March 26th and April 1st. The market has bounced off a long-term trend line going back till 2009, all the way back to the beginning. And it came down there and tested last week, and it held again. So it looks like they're going to try to accelerate it off this trend line with this favorable cyclicality and favorable seasonal cash flows. As you know by now, when the federal government collects those taxes on April 15th, they use that cash to pay down debt for a couple of months. That cash goes back into the pockets of the accounts of the holders of the paper that is being paid down. And some of it finds its way into the stock market. Generally, the last couple of weeks in April, we're looking at something like 80 or 85 billion in paydowns over the remainder of the month until the last day of the month, when the Treasury will settle some new notes and bonds. But between now and then, very favorable liquidity, very favorable seasonality, and very favorable cyclicality. So batten down the hatches, bears. This could be a rough couple of weeks. However, after that, maybe we're looking at the final blow-off. Although the liquidity factors will be somewhat favorable into June, this does look like the last run. One of the projections on the 10-12 month cycle suggests that the market could run all the way to 2200 or so. The levels to watch in the short run are at around the current close, where the market closed today. It has actually inched above the trading range of the last couple of weeks. If that continues on Friday morning, then the next benchmark to watch is 2105. And once it gets through there, the momentum could pick up on the upside. If either of those holds, then maybe the seasonal liquidity factors and the cyclicality won't matter. But right now, the odds favor the upside as far as that's concerned. Well, we had the Fed minutes today. We talked about this the last time the minutes came out. I picked up on the fact that the discussion, a lot of the discussion centered on the tools that the Fed intends to use to raise rates. It was clear to me in the reading of the February meeting minutes that the Fed heads were pretty concerned about the tools that they had to raise interest rates. And nobody in the mainstream media picked that up. And then I wrote a couple of articles predicting that the mainstream media is going to start catching up with this. And one of those was the announcement of the Dog and Pony Show by Bill Dudley Do-Right of the New York Fed, going around to various institutions trying to reassure them that the Fed does indeed have the tools to manage interest rates. I've been highly skeptical of that, as you know, and I predicted that once the mainstream media picked up on it, that the first guy to do it was Jonathan Spicer at Reuters a couple weeks ago, and I predicted at that time that in about a week or so, John Hilsenrath would catch the scent, and obviously in this month's minutes, they did discuss it again, and a couple of the reporters have picked up on that and featured articles about this issue. But again, they're still soft pedaling it. They don't seem to have a handle on the fact that these tools, the interest on excess reserves, the interest they're going to pay on reverse repos, and the interest that they're going to pay on the term deposit facility is counterproductive to their aim of raising rates. If you pay interest, if you pay additional interest to the banks, that certainly doesn't act as an incentive for them to raise rates. That lowers their costs, increases their income, enables them to compete more aggressively in the market to place the cash that they're holding. And the other point